for having TriplePoint join your webinar. It's really appreciated. Georgina and Sam, I guess for the purpose of this, let's try and make it interactive. So it's not just me and Max talking at you guys, as it's a nice small group. And for anyone catching up on recording, then yeah, we'll drop our contact details over to Mahan so that you can contact us after this if you have any questions at all. By way of introduction, so I'm Faye Williams and head up our retail sales team. And I'm also joined by Max Sellers, who sits in our business development team. So across the retail sales team, we have around 40 people dotted around the country and in our London to support you with this area of planning. I guess the purpose of today, what we're going to be looking to cover, just to give you a kind of feel, is how you can be thinking about preserving your clients' capital when it comes to alternatives to pension planning, really, is what we're going to be touching on. So off the back of the budget 2024 and the budget 2025, there's been some changes which mean that more and more clients are looking for alternative ways to plan during accumulation and during decumulation. So we're going to be touching on business relief and VCTs. Hopefully that's not a surprise. That's the area we operate here at TriplePoint. So that's what we're going to focus on today. But what we're going to do throughout is just try and open up the planning opportunity a little bit for you, so you can see how this works in practice and the types of clients that you could be having conversations with around this type of planning. This is our risk warning slide. That the main thing for you guys is that we operate as a team just with financial advisors. We're not here to provide advice to clients. We're not here to deem whether this is the right type of investment, but these are deemed as high risk investments. So from your perspective, you can lean on us to support you with that recommendation process. We can give you the kind of why TriplePoint, why business relief, but we're not there to advise whether it's a suitable investment for your clients. So that's where it comes over to you. It's also worth just bearing in mind that some of these structures that we're going to touch on might not be as liquid as other investments you look at. So I'll touch on what that looks like for our investments today, but it's always just worth asking the question, if you're speaking to another provider, how do they provide that liquidity? Because we're going to be touching on unquoted structures through business relief. So that liquidity isn't as liquid as the main markets. And that's the main things. So who are TriplePoint? Who have you heard of us? Georgina, yes. Sam? Yes. Okay, good. Sam? Don't have to answer if you don't want to. So good. So if you've not heard of us, we sit mainly on the tax efficient side, we'll call it, in terms of the strategies that we offer for advisors. So we have a VCT, which is on the left of this slide, the TriplePoint Venture VCT, and we have a suite of legacy products for estate planning, which we're going to touch on very briefly today. But again, we're not going to be focusing too heavy on products, so you can just contact us after the webinar if you want to find out more. What you probably don't know us as well for is that we also do have fixed rate, fixed date solutions for clients who are looking for income. We have a service which is going to be coming out later this year, but the one we have available today is the TriplePoint Income Service. And to just give you a feel for where that can work really well is, given that the environment is ever changing in terms of returns for clients, and clients have got quite used to nice returns in their cash accounts, they're probably going to be asking more questions. Okay, well, how can I retain this type of return profile going forward? And they will need to take a bit more risk to do so. So our income service has been running for 7-8 years now, and that the type of return you can look for there at the moment, if you were to come in on a 3-year term at maturity, would be around the 6.86% mark. So individuals can invest in that, but where we see most of our money coming in is actually corporate clients accessing that service. So again, I'm not going to touch on that today, but that is an area of planning which we do support advisors with, and everything we do is just to support advisors and the client conversations that you're having. So throughout the session today, there's going to be 3 key areas that we're going to touch on. The first one is just going to be talking about some of the planning implications off the back of the 2024 budget. Then we're going to be looking at how business relief strategies can match your client objectives when you are looking at inheritance tax planning. And then finally, we're going to touch on venture capital trusts and VCTs, as I'll refer to them as, and how that type of planning can be used in practice and what type of clients to keep your eyes out for or to have conversations with in your existing client book. So that'll be the 3 objectives we will touch on. So hopefully If you're on the call, that's what you're expecting to hear about today. If not, I apologise in advance. Okay, so the backdrop. What are we seeing? Well, it's no surprise that the recent budget means that taxes have in some way, shape, or form increased, whether that be the fact that thresholds have been held for longer, whether that be because there's been slight tweaks to the tax that people are going to be paying. But one thing is for certain when it comes to inheritance tax specifically, is that we're expected to see that tax take increase over the next couple of years. And you can see that they're expecting to take over 14 billion by the time we get to 2029, 2030. One of the biggest reasons for this is going to be the fact that pensions and the fact that they'll be looked at for inheritance tax purposes after April 2027, depending on the client scenario. And that's actually expected that 153,000 additional estates are either going to have an increased tax for inheritance tax or are going to have a new inheritance tax liability as a result of those changes. So what we're actually seeing is lots of clients who have never had to have a conversation around this in the past are going to be brought into that scope going forward, which means there's a hell of a lot of education to do over the next couple of years for us as a provider, but also for you as a financial advisor. So we want to be here to support you with that. And just when you are having those conversations with clients, we've built a lot of educational material depending on where those conversations are, whether it's really early stage and you're just having a first conversation about inheritance tax planning, or whether you're actually through that process and you're at the point where you're looking at what kind of solutions are out there. So IHT is on the rise. This is actually quite interesting. It only goes up to 2024, but the point is the same whether it goes on further than that. But actually, if you looked at what the nil rate band would be if it had risen in line with inflation, this is what it would have been. But as we know, it's frozen and it continues to remain frozen until 2030. So this is why we're seeing so many clients being caught in that inheritance tax trap and why we've seen the figures continue to rise. But also, again, touching on the pension changes that will bring more and more clients into this trap going forward as well. So what are some of the changes to inheritance tax that we have seen? I've touched on a couple of these. I'm going to touch in a moment on what we've seen for business relief. So I've got a slide which just outlines what's coming into play for that, because that's coming in April 26. But generally, there has been a lot of change. I've been operating in the tax efficient space, working for TriplePoint and another provider as well for the last 10 years. And these are the biggest changes that I've seen relating to this space. I think especially when it comes to the types of clients who have, even on the business relief side, who have been using business relief for many years now, whether that be AIM or unquoted, this is one of the biggest changes that we've seen. So the opportunity for you as an advisor, but also the opportunity for us as a provider, is that we see that there's a lot of education needed over the next couple of years. And that's where we're going to be focusing a lot of our time, be speaking to you about, changes like this, but also speaking to you about the planning opportunity that presents. So what does the business relief change look like? I'm just going to switch forward one extra slide just with the order. So we've seen for the first time in business relief history is that it's actually split out the relief and what's available depending on whether you're holding unquoted shares or whether you're holding AIM listed shares. So up until April 26, the way that this was treated was the same across all business relief qualifying investments. You had unlimited allowance and you got 100% exemption from inheritance tax as long as you're holding the shares for 2 years and at time of death in a business relief qualifying investment. So after April 26, what's the change for investors? Well, the first change is making sure that clients have actually maximised their allowance of 1 million per person, and that is transferable. We've just seen that confirmed in the recent budget in 2025, which was a really well change because I think it's been quite a complex piece of planning to put in place. But we've seen that you've got, let's say, because it's transferable, you've got a 2 million per estate, let's assume, under normal circumstances, allowance for business relief that can be held in unquoted shares. So maximising that is going to be really important for clients going forward if they are concerned about inheritance tax. And then beyond that point, it will be taxed at a 50% rate, so an effective inheritance tax rate of 20%. Whereas shares in AIM quoted investments, if clients have got them held in AIM ISAs or AIM GIA, they will actually come in from a zero value up all AIM holdings from April 26 will be subject to a 50% business relief rate. So effectively, again, it's just thinking about where clients are holding their business relief and is it structured in the right and appropriate way for them. Now, if you've got clients that you've advised in AIM ISA over the last couple of years, and they're in a situation where they're concerned about IHT, but it's not necessarily their number one concern, and they're still looking for quite a lot of growth over the next couple of years, and they're still young enough where it's not a number one concern for them, AIM might still be the right environment for them. So I don't think this is about chucking everything in the air and restarting what type of planning you're doing, but actually it's just about considering, are your clients where IHT might be more of a focus, they might be slightly later stage in life, they may have had a health scare recently, have they maximised that allowance that is available to them? And I think what we found more generally is off the back of the 2 budgets where business relief has been mentioned twice now, we have had a lot more, I guess, inbound inquiries from direct clients who didn't know about business relief before. We don't typically work with direct clients. Like I said at the beginning, we work with you as financial advisors. And I think it's just this education piece. What is business relief? How does it work? How can I access it? So that's the changes. I'm going to go back one slide. This is what business relief is, if it's a new area of planning to you. So there are 4 main ways that we see clients accessing business relief. The first typical one is if they hold shares in their own business that qualifies for business relief. If that is a trading company that meets the trading requirements to be a business BR qualifying business. The second one is where we operate as Triple Point, so unquoted BR providers such as ourselves. Wish we were the only one, we're not. There's a few of us, so you do have options there. The next one is AIM shares. Some clients invest themselves in AIM holdings. We've been sent some, really funky AIM holdings to transfer over recently, but a majority of clients, if they're coming into an AIM business relief holding, have gone through a provider. So lots of providers have had their AIM portfolios as well. And then finally, the enterprise investment scheme. It's not a guarantee that when you go into an EIS, you also get business relief, but typically the businesses that qualify for EIS are also going to qualify for business relief and meet that trading criteria. Now, the key thing is you might get the relief up front, but business relief is assessed on death, EIS is assessed on entry. So you need to be sure that if you do go into an EIS, if that client continues to hold shares in that company, that by the point in which they pass away, that it's still focused around achieving business relief. So sometimes we do see clients actually sell out of their EIS holdings and reinvest the proceeds as well, which I'll just touch on in a moment, because that is one of the benefits of business relief. So that's the ways you can access. What are some of the benefits of business relief? Well, the main reason that clients invest doesn't actually tend to be because it's 2 years, even though you only need to hold the shares for 2 years out of the past 5 years, assuming that you've held them on death. It actually tends to be the control and access point. So quite often when we're speaking with advisors, their clients haven't actually put this type of planning in place for inheritance tax because they're worried about the what if. What if I need the capital in the future for care home fees? What if something else happens to me? And that kind of worry means that they tend to sit on the capital and not necessarily maybe put it into a trust or start to put quite heavy gifting plans in place. So business relief has probably been the most popular for clients in that situation, where actually it's that control and access point because they're just investing in an investment. It's deemed as high risk due to the nature of how it's structured. But as long as they can get their head around what we're doing and how we're investing, it's an investment and they're holding shares in a company or companies, depending on the provider you're going to. So they have the ability to sell those shares at any point subject to liquidity, which gives them this beautiful scenario for them that if something is to happen in the future, they can actually get access to that capital and they know they've got that peace of mind should that happen. So that's the main reason we see clients coming in. But I touched on a minute ago the fact that we see clients maybe selling down their EIS and going into a business relief environment, a solely focused on business relief environment. And actually the point at the top here that you can hold the shares for 2 out of the last 5 years means that you have flexibility of where you hold your business relief investment because the test is actually on death. So when looked back on death, it's looking back 2 out of the last 5 years, which means you can have a 3-year window where you're not necessarily holding business relief shares, where you might have sold out of one investment and be reinvesting into another. Now, as long as they don't pass away in the period in which they're selling the investment, so if you're coming from AIM and going into unquoted, make sure that window is as small as possible. But we would expect them to get replacement relief, and we would expect them to get immediate IHT exemption as long as they pass that test 2 out of the past 5 years. So that's a really powerful bit of planning. It can also be super powerful for clients who are selling their business, might not want to run their business anymore, and actually want to reinvest the proceeds into a more managed business relief service like what we offer at Triple Point. And then the final point on here is that it's pretty simple to set up. It's an application. There's no medical underwriting required for this type of investment. And as long as they can get their head around what we're doing and how we're doing it, they tend to find it quite a simple structure compared to the likes of trusts. But that's not to say we don't see clients using this in conjunction with trusts, because it can work really well with that type of planning too. Okay. Any questions before I start running through some planning scenarios and how to bring this to life?
Not yet, no.
Brilliant, thank you. Okay. I'll keep an eye on chat as well in case anything comes up in the chat box. So I touched on pensions. This will hopefully, if you've got clients in this situation, give you the ability to bring this to life for them and really show them what the potential impact is going to be. I've seen lots of different ways people are trying to illustrate this. Even on LinkedIn, I've just seen, the simple table. This is what you're going to be pre-April 27, and this is what you're going to be after. Tried to make it slightly more visual, but we've also got an inheritance tax calculator you can use, which we can give you access to. It's also on our website. And again, that gives you a bit of a graphic if you want to have these conversations and bring it to life. But in this example, we've got a client who had an estate worth 1.3 million here, but also has an unspent pension of 1.5 million. So quite simply on the left, the pre-April 27, you can see that the inheritance tax liability is pretty small. What you can see post April 27 is that is shifting right up towards that £1 million mark. And I think the piece of education, which is going to be really important to clients in this situation, which they won't have necessarily had to think too much about, is it's kind of taken us back another like 4 or 5 years, because we had to talk about this a lot when these changes came in, but is around the residence nil rate band and how that can get tapered back if you do go over the threshold for that tapering. So clients pre-April 27 who have an estate of this side have never had to consider that because their estate hasn't met that threshold. But actually, you can see here in April 27, they've lost access to that residence nil rate band due to the size of the estate. So again, this is going to be, it's almost going to be like reliving the RNRB changes, isn't it? So I think that's going to be a really important conversation. And back to the stat that I said to you at the beginning, it's been identified through some of the research that's been done. They're expecting about 153,000 additional estates to be caught by inheritance tax or have an increase in inheritance tax between 27 and 2030. I actually think those numbers are quite conservative, but some of them say a lot higher depending on the source you look at. So there's going to be a lot of clients who need to understand this piece of legislation as well. And you can have access to our slides after today if you want to draw out any of these scenarios with your clients. So next up is just, it's not as dramatic because of the volumes we're looking at here, but depending on how much your clients might hold, if you've got clients holding AIM, this just shows you again what's happening in 2026. So a bit of an earlier change, as I've mentioned, the AIM versus unquoted changes. So in this example, this client has got AIM holdings and non-AIM holdings, and you can see here that they get 100% exemption across them pre-April 26. What happens post-April 26? Well, they're going to be able to pass less to their beneficiaries. On this example, it's £100,000 less will go to their beneficiaries. And if they do want to ensure that they can retain that, having that conversation early and getting that transferred over to an unquoted to maximise their allowance could be one way of increasing that, what is going to be inherited by the beneficiaries. Now, if you have clients in this scenario, we've put together a 2-page document which you can request from us, which basically shows you how it actually works in practice when you're transferring AIM over to unquoted shares, just for you to support you with those conversations. So please just get in contact with us if you want to see and access that document, or pop it in the chat box and we can take that away today. Something which I think is really important is we talk a lot when we're talking about planning for business relief and inheritance tax around what happens up front. You know, what do we do to put the planning in place? One of the most important things about this type of planning is actually what happens on death. It's very morbid. Max and I have quite a morbid job, you know, talking about inheritance tax and dying basically pretty much every day. But what happens on death for you as an advisor with your clients in terms of what's going to happen to those assets, but also how you support the beneficiaries, the executors of the estate, and anyone else professional connections involved in supporting that estate is also really important. So we like to talk about this up front because we really value it, and we have a dedicated estates and probates team here at Triple Point who are here to support you, the client, and also anyone else through that process at that point. And it can just hopefully make it a bit more streamlined, a bit more efficient to help you at that point when that comes. So what happens on death with business relief is there are some options that you have. So with the first one, quite simply, with some of the transfer rules, there's something which a lot of people are not aware of, which if an investment is business relief qualifying, when it is inherited by a beneficiary, we would actually expect that they would inherit immediately exempt BR qualifying portfolio. So if they've got their own inheritance tax liability, they can inherit the shares and actually not need to do a new 2 years. They do still need to hold it at death to get the exemption. So, you know, if let's say, for example, they're inheriting that in their 70s, they might need to hold it quite a long time, depending on their situation. But I think it can be a really powerful way of talking about that intergenerational planning at the front in terms of what they can do. So that's one option. Second option is we can sell the investment. We are operating at the moment with our Triple Point estate planning service, which is around 1.5 billion in size, on a 7-day turnaround for the last 12 months. We always record on our quarterly fact sheet how long it's taken us to provide liquidity. But at the moment, that's taken around 7 days, so pretty quick. We tend to buy and sell shares every Wednesday, and we've not had a situation where we've not been able to facilitate the sale of shares or purchase of shares as well. So 7 days is typically what we're operating. So if you were to put a request in, as long as all the paperwork is correct and we've got everything we need for that grant, you know, like probate, for example, out to the beneficiaries, then we could absolutely do that. So that's the second option. And also, I guess that liquidity point is important in terms of what we touched on, where clients might be investing for control and access, should they need the fees for care homes or anything like that. And then finally, one that's probably the least known is that a business relief investment, in terms of how we set up, we actually sign up to something here at Triple Point called the IHT Direct Payment Scheme. And what that enables us to do is to be able to pay the IHT bill directly from the client's business relief portfolio to help settle their inheritance tax bill to actually release the funds for probate. Now, where I think that's going to be really powerful in terms of your conversations with clients is if you have clients where they are still going to have an inheritance tax liability, especially because they've got assets tied up in their pension, they've got assets tied up in their property, and they've got a lot of liquid assets that they can't do anything with. If they've built up a business relief portfolio on the side and they can actually pay their inheritance tax bill from this tax efficient vehicle that they've created here and release the funds for probate, it may save the beneficiaries having to take out a loan or something like that to actually fund that inheritance tax bill to release the funds. So that's something we do on a regular basis. It's something we don't normally talk about up front. We normally talk about it on the back end. But given the changes that are coming down the line for pensions, and who knows what the administration to pay those bills is going to look like from those pension providers, we think this is a really important one to know that you've got in the back pocket should the client's beneficiaries actually need that in the future. So you've got options is the key message to take away from this.
I think just to add to that one, Faye, I've been speaking to some of the guys in your network and reaching out, and I think this is the biggest one at the moment, especially to advisors who haven't maybe interacted with business relief before. I think it makes you guys comfortable with the products. You know, it's something kind of that's what insurance does, although it never solves it like we do. It does offer an opportunity to pay. That's going to be the biggest challenge, and it gives clients a bit of peace of mind that their bill is going to be paid. So I think when it comes to looking at what you can do with these assets, they aren't just an investment, they aren't just mitigating IHT. You know, they can make what is a pretty difficult period a lot smoother. So I just think it's really important to emphasize that point. It's definitely the headline piece at the moment.
Yeah, I couldn't agree more, Max. And I think also, like you touched on there, it is probably one of the most difficult periods that someone will go through. And options and flexibility at that point is going to be really powerful and hopefully make their life a lot easier as well. Okay, so here is just a flavour of some of the other clients that we see. We see a lot of different scenarios. I touched on the fact that we see trust clients using this in conjunction with trust planning. And if you have got clients in that scenario who want to access potentially both, just come and speak to us because we can talk you through how it works. But we also see clients who have a power of attorney in place, using this type of planning, limited life expectancy, of course, given the 2-year nature. We've touched on retaining access and control. I actually looked for a webinar the other day at what the average care home fees were at the moment. I used ChatGPT, obviously, and it came up that it was like £6,000 to £8,000. And I was just like, oh my gosh, like the costs I think that people are paying for these care homes are absolutely crazy. And also that's not even taking into account special needs. So there's the costs that could be coming out are really high. The other one, just to touch on here, which we've not touched on, is one of the conversations we're having a lot more at the moment is clients who are thinking about, well, how do I reduce my inheritance tax liability when a lot of my capital is held in my pension? And one scenario could be using that lump sum, that tax-free lump sum, and actually investing that into a business relief structure. So that's another consideration that clients could make depending on their scenario. So one we don't talk about as much, but we thought we would talk about today, just to leave you with it as kind of an idea, and one that's really powerful for if you work with accountancy connections and you're looking to maybe gain traction with additional referrals, or just work a bit closer with them, is actually considering corporate business relief. So I understand that you guys are whole of market, so you can look at lots of different options. This is probably more niche, but what it does tend to be is higher case sizes. So our average case size for the Triple Point Estate Planning Service sits, the one that we've just touched on that would be used for those types of clients, your kind of personal clients, sits at around £120,000. But actually, the typical scenarios we see for the corporate estate planning service tend to be anywhere from 5 million upwards. The initial investment size can be a lot lower than that, but it does tend to attract your larger kind of clients into this one. So in this example, what we've got is a client who's actually run their own business for many years, and you can see here that they've got trading assets of 800,000 and they've got £1 million in cash. What that means in this scenario is that likely to fail the business relief wholly or mainly trading test, which means they're actually going to lose that IHT exemption on the business, unfortunately. So what can they do? Well, actually, we have a corporate service, and it's a slightly different structure because you wouldn't be able to invest in the personal structure that we've got because it would actually be deemed as an investment, and it wouldn't qualify. So what we do is look to get the capital from the business here trading. You become part of a partnership. And in this scenario, they've actually put £600,000 of their cash into our corporate service. They've kept that £800,000 of trading assets and decided to retain £400,000 in cash. What this has done is push them over that 50% mark for wholly mainly or trading test and ensure that they're going to qualify for business relief if they were to pass away. What it's also done is got that capital working again, and is hopefully, assuming we meet our target return, going to produce a higher level of return for clients as well, compared to that cash proportion in there. So it's a bit more of a niche one, but it's one to have in your back pocket should you come across clients in your own client book, or if you're working with an accountant where they might be working with companies who might retain excess cash. And once you've done the typical, max out their pensions, taken out any capital they can, maybe used a VCT, which I'll touch on in a moment, to extract maybe a large dividend, you might be in a situation where you still need to do more. And this could be an option for retaining that capital within the business, but getting it trading again. So this isn't a product push. I'm going to leave you just with a bit of information. And if you have any questions, you can come back to us. I've touched on 2 of these already. So on the left, we've got the Triple Point Estate Planning Service, which makes up one of our 3 core estate planning strategies. So that's for your individual clients that we've touched on. You can do a single or a joint application, super flexible, and the minimum investment is 20,000. We've also got the corporate service, which I've just touched on, which is the bottom right, which the minimum investment is 500,000. Based on the scenario just mentioned to you, it does tend to be larger, high net worth clients. Then we have this strategy, which kind of sits in the middle, which if you think about it as a personal trading company, it's where we set up effectively a corporate service, but for an individual. And where that might be interesting for your clients is if the kind of scenario we see is if someone is coming into some capital now, but also they've got some capital coming in a couple of years' time, and they may want to operate their own rights issues from that personal trading company. I'm not going to go into detail on it today, but I'll just leave you with that. If you've got clients who are quite bespoke, maybe they're selling a business and they're getting a payout over the next 2 to 3 years, just come and have a conversation with us and we can talk you through how that planning kind of works in action. So they're the 3 services we have. This gives you a feel for what we invest in. Most advisors I speak to know us for being investors in ambulances. That tends to be the one that comes out. Oh, you guys invest in the ambulances? And I think, I'm not in the room today, but in one of the rooms there, we've got the ambulances, little mini ambulances on the wall, if you ever come in. Key thing to remember is our estate planning strategies focus on lending and leasing. So it's debt-based structure. We have some really reputable counterparties, such as local councils, such as the NHS, such as DPD, as you can see on here. Lots of different sectors underneath the bonnet. And again, we can talk you through in more detail if you've got a client opportunity to talk through. And the final thing to just leave you with as a flavour of the service is that you get the option to invest in one or both of these strategies. So your clients can come into our generation strategy, which tends to focus on the lending and leasing to large corporates, and also the public sector, like I just touched on, lending and leasing for ambulances, or the navigator strategy. So it really depends on the return profile that your client's looking for. So for the last 12-month period for generations, we've delivered a 2.37% return. And then if you look across the navigator, we've delivered a 4.31% return. And many clients, as you can see kind of at the bottom, will come into both strategies half and half. So they don't have to pick one or the other. And across the strategies, we've got just around 1.5 billion invested in our inheritance tax suite now. So you're getting access to a super diversified portfolio as an investor, but they do have the option to choose as well. Any questions on inheritance tax or estate planning before I whiz through our VCT?
Okay, you mentioned liquidity at the beginning. How does that work with the 2 strategies, the navigator and the generations? Is it the inflow versus outflow?
Absolutely.
What does that look like?
Yeah, absolutely. So we create a trading event every Wednesday, and we've always ran it on a Wednesday. So typically we have at the moment we're probably going to end up somewhere around 320 million into the portfolio for this year. And we're probably going to end up somewhere around 50 to 60 million exiting the portfolio. So we have a lot more capital coming into the portfolio than we do have coming out. So that's how the first way in which we provide that liquidity, and that's how we're continuing to meet the 7-day window that I mentioned. If there was a situation where business relief was removed, and I think it's always important to think about what if, worst case scenario, we would actually derive that liquidity from the underlying trades themselves. So that would come from the lending and leasing itself. So lending and leasing, next year we've got a third of the book which is rolling off, and we'll be looking to reinvest. So if we were in a scenario where we had to wrap up the book itself, we would expect that would probably take us about 18 months to 2 years to do so. And some of that would be selling off the loans and leases, and some of that would be that natural liquidity that's coming back in. But that's your kind of absolute worst case scenario if everyone wanted to exit tomorrow, which we've not had a scenario of to date. If that answers.
What's the default rate like?
It's low. So we factor in around 1% default rate for both strategies. And for generations, it's below 0.1%. Max, you might know off the top of your head, but it's below 0.1% when I last looked. Navigator, I think it sits more around the like 0.5, 0.6% mark, because we're lending to SMEs, and you will see slightly more defaults coming in by way of SMEs than you will, for example, NHS or corporates like M&S will sit in our generation strategy, much larger corporates. So it's a low default rate, but we do factor it in. It does exist.
Thank you.
Any other questions at this stage? Cool. Thank you. Okay, so switch your mind completely from inheritance tax to income tax. So VCTs, we haven't got a slide on it, but I think it's the first thing to mention is that we did see some changes in the budget that's just been, where two changes for you to be aware of. The first one is related to clients investing. So the clients at the moment between now and April 26 will get up to 30% upfront income tax relief if they invest into a VCT. So if they do an investment of £200,000, we'd expect they'd be able to claim up to £60,000 off their next income tax bill. That is actually changing April 26 onwards, where it will be post-tax year end. We're expecting that to be 20% income tax relief. So that'll be a drop from the 60,000 to the 40,000. So that's a really important change to be aware of. What does that mean for you right now? If you've got clients wanting to invest in VCT, I think get in early. It means that a lot of clients we're working with are looking to up what they were investing this year based on the fact that they do reoccurring VCTs, and they're going, okay, I'll just put a bit more in this year if I can find a bit more capital to do so. So bear that in mind. If you've got clients looking to access VCT, if you want to choose your VCT this year, I think it's important to get in early. What does that mean going forward? Not too much, I don't think. There's not really another vehicle like a VCT that offers such generous tax reliefs and offers the liquidity that VCTs offer and offers the tax-free growth plus the tax-free dividends. So the Triple Point VCT, as an example, we target 5% dividends per annum. Most VCTs now in the market are pretty mature and will target a dividend rate. And I think, I guess reading between the lines, this is probably one of the reasons that the upfront tax relief has come down, because you've got access to a real suite of mature VCTs out there. And then the second is actually super positive, meaning that we can effectively invest slightly later stage going forward. So with a VCT, you are restricted by way of the company size, company age that you can invest in. That's the way that they keep it, to ensure that you're investing in the right types of companies with those restrictions. But they've actually extended them, and they've extended them by quite a bit. So what that means for us is we can go back into some of our companies that we are backing early, and we can actually continue to follow through the funding with them, and get access to them later stage, and also access slightly later stage companies. So that's a real positive. But the upfront relief change is one to be aware of that is coming in from April 26. You also have, sorry, just as a reminder, you also have a £200,000 allowance as an individual, so a very generous allowance to come into VCTs per annum, and you're expected to hold the shares for a minimum of 5 years. If clients need to sell before that, they can, but they would lose access to the tax relief, so may be liable to pay back tax, for example, if they've taken the upfront tax relief. So just worth bearing that in mind as well. VCTs have been very popular, so don't need to dwell on this too much, but you can see the growth that they've had. What's going to be interesting to see this year is what I just mentioned then. We've already seen, off the back of the changes, we've seen a lot more applications. We're on track, as all the VCT managers are out there, to have the best year that we've ever had for VCT fundraise. You can actually track the numbers on Wealth Club for those of you who ever want to track what the VCT market's doing. So it's very open. They track the whole market pretty much, their numbers. So yeah, on track to have a really good year this year, but that does mean that your clients are probably going to be limited if they leave the planning slightly later, and wait till around February, March. Not sure how many providers will have allocation, because they may have filled what their prospectus is allowing them to raise by that point. So just keep that in mind in terms of timings of your clients. maybe it's one they could go think about over Christmas, you know? So as a reminder, income tax relief isn't just on earned income. So this point comes up quite a lot, but they can actually take it off their total income tax bill. So that could be anything from their rental income, dividend income, pension income, which could be a really interesting one going forward for any of your clients who might actually look to switch on their pension income. They might have had it switched off up until now, but that might change going forward from April 27. And also the one which which gets forgotten about is the tax if you've got a client who is actually surrendering a bond and expecting that would be an income tax charge. They can offset that charge as well. So if you've got any clients in that scenario who've got any bonds they're looking to surrender as well. Okay, so I'm going to touch on a couple of these to bring it to life for you. The first one I touched on earlier, but in relation to clients where you're working with corporate clients or where you're working with accountants, maybe as professional connections, and looking to increase the referral opportunities that you do work with them on, it may be an opportunity to talk to them about how they're extracting their profits from the business and if they could offset the tax using a VCT. So in this example, we've got Raj, who's currently paying himself a salary of 12,570, but he's paying the majority of his earnings through a dividend of £50,000 per annum. In this example, what you can see on the left is what happens without the VCT. So the total amount after tax is 55,164. But on the right, you can see if just over 24,000 goes into a VCT, if you work that example through, the tax relief it generates, and it's actually left with 62,570, assuming that the VCT holds its value. And on top of that, there'll also be the tax-free VCT dividends, which depending on the VCT you choose, depends on the dividend target that's going to be available. So in that scenario, you can see the difference, and this is just looking at quite a small investment of 24,000 into the VCT. But again, if you were to up this towards the upper end of that VCT for a client, and they were to do a £200,000 investment, you can see hopefully the impact that can have on that additional tax relief and what they could be doing with that. So that's one option that could be talked about if they've already maxed out their pension, perhaps, or if they have now got a cap on an annual basis for their pension due to their earnings as well. So next up is recurring VCT. This slide is based on a 30% income tax rebate. So all I would say is we're working through at the moment, updating them off the back of the changes. The only year they're going to get the 30% income tax rebate at the moment, to our knowledge, is going to be this year, and then it's going to go on to 20%. So this example is slightly off in terms of the calculations, just bear that in mind. But in principle, the same applies. So VCT is one of the only vehicles where you can sell your shares after 5 years and then gain new tax relief on that same capital and go into another VCT. Something you need to bear in mind if you're going to do that type of planning is that you can't go into the same VCT within 6 months. So that's really important when you're choosing your VCTs up front. Is it that you want to switch the VCT provider you use every year for clients? How do you want to manage that? Because if you've got 10, 15 clients doing a VCT, you might just want to think about that up front if you're planning on rolling them over after year 5. What that does mean is over 10 years, if we think about the relief change from 30 to 20%, is they can actually get 40% income tax rebate over a 10-year period. And you can see here how that annual income starts to build, that cumulative income tax rebate starts to build. So it can end up as a really powerful actual retirement planning tool. So we have some clients who sell every 5 years their shares, but what we actually see more and more is clients just continuing to hold it for the dividend benefits and not worrying about selling out and going back in. They've got their initial income tax relief and they're actually holding it for those tax-free dividends, which with some of the dividend changes we've seen have become even more powerful in terms of the rate in which they are coming to clients at. So this is just an example to get you thinking about how you can use it as that annual planning tool. Finally, before I wrap up, I said 40 minutes, we're on 46, so I will speak quick. If you want to invest in the Triple Point VCT, we do have our VCT still open. We have an offer for an early bird offer, which is running up until the 31st of December. Fully aware that's very, very soon. So your clients might not be able to make that. They'll go on to normal fees after that. If they can possibly make it before the of December, the triple point fees will be discounted by 1% for new investors. So from 2.5% initial to 1.5%, or by a further 1% if they're an existing shareholder in the VCT as well. So they can actually come in for 0.5%. So, and we typically, can never guarantee it, but we typically do the existing shareholder offer every year, which is nice for when clients do come back in year and year and do that reoccurring VCT. So what do you get if you come into our VCT? Well, our VCT is just over 100 million AUM. So you're getting access to a pretty mature portfolio, which I'm going to show you in a second, but around 50 plus companies across 20 different sectors. So that's what they're buying into. So for those of you on the call who have maybe used EIS in the past, where your client is getting brand new shares in brand new companies every time, it's a very different structure where your client's getting access to the VCT itself. We focus solely on early stage B2B businesses. That's where our niche is, let's call it. Seb Wallace, who founded the VCT, the co-founder of our VCT, is also a co-founder of a technology business. So it's also his sweet spot. So he's built a team around him where their expertise is all around B2B. We've got individuals in that team who are ex-Revolut, and just know the B2B space very well. So they focus on sourcing those deals across multiple different sectors, whether that be healthcare, for example, as one of the sectors that we really like. And as I've touched on, your clients, what can they expect to get going forward? Well, we target a dividend yield of 5% NAV. So hopefully if they're using this retirement planning vehicle, or whether they just are using it as a tax-free source of income, then that's what we're looking to target for them on an ongoing basis. So here is a bit of a snapshot of this is quite a long time ago, so June 2025. But this is a snapshot of where our companies tend to be in terms of where they are at their funding stage. So typically we're investing quite early stage, as you can see on the left. So in 2019, this is what the VCT looked like. Mainly the companies we're investing into were at seed, and then Series A, and then pre-seed. But because we're holding shares in those companies and hoping to ride them out until the point in when we can derive an exit, and derive an exit that we like the look of, you can actually see how mature the portfolio is on the right hand side. So if you focus your attention a bit more to the left hand side, you can see what we hold in Series A, Series B, and Series C, which is actually around 50+% of the portfolio now. So clients investing today, even though we invest early stage, they're not investing in early stage companies per se. They're investing in a fairly mature portfolio as it stands today. And if you want specific examples on companies that we invest into, we hold about 10 companies in the brochure itself, and you can see more in the prospectus as well, so they can get a real feel for what they're coming into. And Max and the team can bring that to life for you as well during a meeting or a call, just to take you through exactly what that looks like. I'm going to stop talking. We have touched on quite a lot today. Hopefully there's something in there that's useful, but we're also running 27 events around the country in January and February. So we would love to see you there, love to meet you. You can scan this, I'll give you just a second, you can scan this with your phone and it will take you to the events page, and then you can just quite easily sign up. I think it just asks for your name, your email address and your company, and you can see which location might be closest to you, but hopefully there's one that's nice and local to you. We're going everywhere. Scotland, Birmingham, Wales, Manchester, Penrith, wherever Penrith is. Yeah, everywhere. I'll give you just a second. Okay. Finally, you've got Max on the call today, who's one of the business development associates here. We also have around 40 individuals around the country, as I mentioned at the beginning of the call. So just lean on us. This is all we talk about day in and day out. So if you do have a client scenario, just pick up the phone, outline what that client scenario is, and we can talk you through the solutions or which service might be most relevant to them. We have everything from initial stage brochures all the way through to example suitability reports, and also, as I mentioned, we have an inheritance tax calculator which you can access to help you build a specific business relief versus general kind of inheritance tax planning structures as well. So just lean on us, we're here to support you. And I think, Max, is there anything else you want to say before we wrap up?
No, I think unless anyone else has any questions, I'd be interested if anyone had any thoughts on kind of recent changes. I think it's always nice for us to hear, what advisors are thinking, especially they're so fresh, right?
No questions. You're letting us get off lightly. That's absolutely fine though. We're okay with that.
Right.
And we
Thanks,
just appreciate you
Faye.
giving up your time before Christmas. So I hope you've all got wonderful Christmas plans.
Yeah. Thanks, Faye. Thanks, Max. Thanks for a lovely webinar. Very informative. Thank you very much for that. Appreciate that. We'll certainly be sharing that with the rest of the advisors.
Brilliant. Thank you so much for having us. We'll see you all
Pleasure.
soon.
Thank you.
Pleasure. Take care. Bye-bye.
Bye now.
Bye. Bye.